All right, what is good? What is good? It's episode 11, day 11 of the Indices Bootcamp. Hopefully, you guys have enjoyed up until this moment. It's your boy Daniel FX. I do apologize about the wait in between the episodes, but like I said on the last episode, I've just got a ton of stuff to do, and yeah, it's not a priority. It's a free video on YouTube, so you get what you're given. Anyways, I am in the bathrobe of truth because I am obviously the US 30 wizard, and I'm here to bestow upon you some knowledge in the form of high probability trading conditions. It's the main focus of today's episode. There is a bunch of concepts that I do want to cover in this next 20, 30, maybe even 40 minutes. Who knows how long this video is going to be. But the main point I want to get across is the difference between high probability trading conditions and low probability trading conditions. Now, first and foremost, you need to understand the one very crucial concept as a trader, that if you look at a chart for long enough, you will find a trading setup. Now, that does not mean you will find a high probability trading setup. That means that if you look at price for long enough, if you stare at these candlesticks, eventually something will happen. You will draw some sort of level, you'll find some sort of entry, some sort of stop loss placement, some sort of take profit. You will see something that is not there. And that is why I always recommend, and this is something I always told to my paid students, is that after you have a system and after you have a strategy and you've understood it and you back tested it and like it's ingrained in you, you should never have to stop and think. You should never have to stop, look at a chart and be like, is my system here? Is my strategy here? Is my key level here? Is this candle? Is this etc.? If you ever have to really stop and think, it's probably not there. Usually, and again, this comes with having a simplified system, having an easy strategy that you understand. But usually, when you open up a chart, it should be super obvious. Easy uptrend, easy downtrend, easy consolidation. Here's my key level, here's my SL, here's a good target. This is a nice fair value gap, this is a nice, etc. You see what I'm saying? It should just be very clear and very apparent. But when it's not very clear and when price action gets a little bit messy and you have to stop and really kind of look for it, you know, first and foremost, that it's probably not as high a probability as it kind of should be. And maybe it's a good idea for you to maybe stay out of that position. Just baseline kind of like rule of thumb for you to go off of. Now, what do I define as high probability trading conditions? Well, we first need to understand that high probability varies. So, let me not write that down because it's going to mash up my chart. So we're just going to delete that. Let's go to a different US 30 here, real quick. But what do I define as high probability trading conditions? Well, high probability varies dependent on what system you're trading. Now, what I mean by that is high probability for a Fibonacci retracement system may look completely different to high probability for a continuation system because they both require different market conditions. So you first need to understand what strategy are you trading and what would like determine high probability for that specific system. Now, for this system that I've been attempting to teach you guys over the past 10 or 11 episodes, we are trading a momentum based continuation strategy. That means that we're looking for price to be in a trending market, create a key level, break it, retest, and continue. So we're looking for momentum, we're looking for price to rally. What we are not looking for is price to have very deep retracements and keep coming back on itself. We're not really looking for that sort of market environment because that's going to mean that we're going to get stopped out a lot more. It's going to mean that some of our continuations don't follow through. Just generally speaking, it's going to be a little bit harder to trade that sort of market environment than it would be to trade a nice, strong rallying market. So let's look at price action. Now, you're going to notice that this links in very heavily to what I said on lesson one, session one, or I might be in session two, and that is impulsive and corrective waves. Now, I know a lot of you guys probably disregarded this information because I said it in episode one, episode two, and it's like a little beginner stuff in it. But like I said, it is the foundation of literally every strategy, any system, any sort of analysis. In my opinion, the foundation is understanding what is the market phase that you're in. Are you impulsive? Are you corrective? Now, bear in mind, this also applies to a daily time frame, and this is primarily where you'll be doing this type of analysis. So let's look at this section right here of price action. Bear in mind, we're on a daily time frame, and this is US 30. Now, an impulsive move is what? It's simply when price has the large breakout movement, doesn't really leave many retracements, very, very strong volume. Now, bear in mind, because we're on the daily time frame, this is essentially like 2 or 3 weeks of price action. Very, very strong bullish market sentiment. You can see we're opening, we're pushing, we're opening, we're pushing, we're opening, we're pushing. Even right here, where we did have a couple of like rejection days, we were still pushing in the same direction. Price was still continuously making a movement. That is high probability trading conditions. Any impulsive on a higher time frame is going to give you very clean price action on a smaller time frame. Because when you have an impulsive on a daily, that means that probably on an hourly 15, 5 minute price is really ripping, it's pushing. Now, Obviously, you're going to still have retracements. You're still going to have points where price accumulates. You're still going to have these types of movements. And that's good because you need to draw your key levels from somewhere. You need to find your stop loss placement from somewhere. Like, you need some element of price like relaxing for you to actually do something. You can't just have a straight breakout. Otherwise, you can't do anything. But this is high probability. Whenever you have the super strong impulsive movements. Now, let's find you another example. Right here, this would be another period, another week where it was very high probability trading conditions. If we were to go back even further to let's look at like this section, even these periods right here where price was having these large bearish days or these large bullish followed by bearish days, even this entire movement to me is high probability because price is essentially printing clean price action, clean market structure on a daily time frame. You can clearly see that right here we have a lower low, a lower high, a lower low. Very, very easy. It's there. There's no like debate about it. You don't have to really sit there and think and look at it, etc. It's very easy to spot what that is. In comparison to a corrective movement, and again, we covered this on session 2. If you haven't watched that, go back and watch it. But in comparison to a corrective movement like this, for example, where on a daily time frame, price is continuously changing its sentiment. It has no clear directional bias. It has no clear market structure, no clear sentiment. We're going from bearish to bullish to bearish to bullish to bearish to bullish. Attempts to break out, comes right back in. Bearish, bullish, bearish, bullish. And all of this is just a complete and utter mess. Now, when it's this messy on a daily time frame, the only thing you can possibly hope for is that on an hourly, you're just in a very clean like range to the side. However, 9 times out of 10 on a daily time frame, on an hourly time frame, it's going to be incredibly choppy. It's going to be very back and forth. There's not going to be any clear structure. There's not going to be any clear levels. The price action is not going to be nice. It's going to be wicking a lot. This is the price action that you need to be avoiding. Now, this is one of the main aspects when it comes into the trading system that I'm trying to teach you guys is we have to be avoiding these bad periods of price action. Now, bear in mind, because we're on a daily time frame, this can potentially last 2 weeks. It can be 3 weeks of price. And this is what a lot of people don't understand. And this is, in my opinion, why a lot of people will never be profitable is because they cannot handle not trading for 3 weeks. They cannot fathom the idea of waking up every day, coming onto their little trading setup. They come, they sit down, they start on a daily time frame, market structure, market sentiment. They see bullshit like this, they see this accumulation, and then they're like, I still kind of want to trade. I still kind of want to find a position. And maybe they can handle it for 1 day. Maybe they can handle it for 2 days. Maybe 3 days. Maybe even 1 week. Maybe you're disciplined enough to go 1 week without trading because last week was terrible price. And then the next Monday you come back and price is still in an accumulation. It's still showing you this nasty price right here. And you're like, you know what? I didn't trade all the last week. I've got an evaluation. I want to make some money. I want to, etc., etc. And you force a setup. You zoom into an hourly. You zoom into a 15-minute, and you look for a trading opportunity. And bear in mind, like I said at the start of this video, there's always going to be a trading opportunity. There's always going to be something for you to trade. Because if you disregard the higher time frame, for example, let's take this section right here. Right here on the daily, we can clearly see that it's messy price. We can clearly see that there is no clear structure. There's no clear sentiment. There's no clear directional bias right here. Essentially, what this is on a higher time frame is this is depletion. That's all we're seeing right here. This is a large bearish movement. We've got a massive amount of depletion on a daily, and then we eventually had that bullish move outwards. But essentially, this period, this little 2 weeks right here, is one big daily depletion. Now, during this big daily depletion, if I were to zoom in and go to an hourly time frame, I could still maybe find the key level. I could still maybe try and place a trade. I could still look for something. But with the higher time frame being as messed up as it is, I'm just lowering my overall odds. I'm lowering the probability that I'm going to hit take profit. And that is what we're here for. We're here to obviously make money in it. Now, you need to understand that if you're not moving forward, you're moving backwards. That's it. There's only one of two ways you can go in it. If you're not trading higher probability, what you're doing, you're trading lower probability. What does lower probability lead to? Well, it probably leads to losses. It leads to drawdown. So the only thing that trading this sort of market environment is going to do for you is move you backwards, and it's going to make it that much more difficult for you to actually come out of that drawdown and make profit. You would really be surprised how far you can get in trading and in life in general by just not doing dumb shit, by not setting yourself backwards, by not putting yourself in a hole to begin with. You can actually just make progress a lot quicker. It's as simple as that. It does take a lot of discipline. It does take a lot of patience, and it takes a lot of confidence in yourself to be like, okay, cool. I haven't traded this week. I'm not going to trade next week. I'm not going to trade until price action gives me what I want to see. I am going to be disciplined. I'm going to be patient enough to actually wait for the breakout, to wait for that one trending week, to wait for that nice period of price, and I'm going to capitalize off of that. Because bear in mind, I'm not telling you to just sit here and not trade whenever price is consolidating. I'm not just telling you to, all right, I'm not going to do anything for the next 2 months because it's not quite 100% perfect. But you need to understand that you are going to have your moments. You're going to have your periods where you have the beautiful weeks, where you have the 5, 6, 7, 8, 9, even like 10, 13% weeks. It happens. Because again, the market goes through phases. There's always going to be continuous little cycles. One thing I want to also clear out is that we don't necessarily only need the huge breakout movements. Like this is ideal, and these like trading, I'm not even cutting this out, but these trading periods right here, these like 1-2 weeks where you have the huge breakouts, these are amazing weeks, but we don't only need that. Even price action like this is still very much acceptable for you to trade because this is still clean market structure. We can still see nice bullish movements. These are still impulsives, nice bearish movements. This is still an impulsive, nice bullish movement. We're creating structure right here. So we've got a key level, bearish movement. We've got structure down here. Like that's still very much tradable because you can understand what's happening. It's very clear. It's very identifiable. It's still price action. That is completely fine. I'm not just saying we need the breakouts. I'm saying what we need to avoid is this nonsense right here. When you have essentially the daily correctives, price are giving you the very small bodies, the very large wicks, etc., etc. Even right now, if we're looking at current price action, the reason I have not personally traded for like the past week and a half, maybe 2 weeks, is because this is the price action we've been getting. It's been very, very low volume. It's been very nasty. You've had a lot of indecision days. There's no clear structure. There's no clear sentiment. It's not a high probability week for me to be trading. Now, of course, I can still trade. And of course, there is still little trading opportunities here and there. But when you're trading 6 figures in capital, and I really want you guys to understand this, but when you're trading big boy money and you're actually like there's a couple of thousands on the table per trade, you're not going to want to sit there and just execute random bullshit for the sake of it. You're much better off. You're literally much better off sitting out 3 weeks out of the month. So literally, week 1 you don't trade, week 2 you don't trade, week 3 you don't trade, and then the last week of the month you execute one good position, 1% risk, you make about 2-3%, and you're out. You process your payout for the month. That's a decent month. I promise you, that is real trading. That is the real I honestly I don't know how else I can say this, but that's the most realistic way that you're going to be trading over the long term. That's the most consistent way for you to actually make money from these markets is to just trade less. It's a simple numbers game. The more trades you execute, the more risk you put on the table, the more exposure you potentially put on your account, the more room you have to move backwards. It's as simple as that. The person trading 10 times a month can always end the month in 10% drawdown. The person only trading one trade a month, at worst, can end the month 1% in drawdown. Now, again, I'm not sitting there and telling you to just not trade because you're scared that you're going to go in minus, etc. Like, no, if the trade is there, if the opportunity is there, if there's high probability, take it, execute, trust the plan. But I'm saying there is no need in you sitting here and trading the BS periods like this because simply out of impatience or simply out of just the fact that you want to trade. You see what I'm saying? But just before I move on to my second point about like dollar correlation and understanding what the dollar is doing to help you identify good probability trading conditions, I want to make one additional point, and that is that you're going to have a lot easier time being more patient in the markets. You're going to have a lot easier time being more disciplined and actually following your strategy and not trading the BS like market conditions when you're also doing something outside of trading. Now, I know, especially when I first started, I literally cannot speak today, but I know when I first started learning to trade, I would always hear people talking about having another stream of income or having another business or doing something on the side so you weren't primarily focused on trading. And I would hear that and I would understand it and it would like make sense to me, but I still wouldn't go out and like try to do something else because I just wanted to trade. And in my head, I was only going to trade until I made a good amount of money from trading and then I was going to move into like another business. And that does kind of make sense, but at the same time, having another business or having something else, even if you're not necessarily making money from it, just having something else to focus your time, attention, and energy on, besides from trading, is going to naturally shift your attention towards something else that you're doing. Whether or not it's e-com or it's like Amazon FBA or you're like writing books or you're washing windows or you're like it doesn't really matter what it is that you're doing, but just having something else is going to be able to shift your attention away from the markets and onto that other business that you're doing. And through that process, you're going to not feel the urge to sit there and trade. A large majority of traders trade out of boredom. They're sitting at home, they're sitting in their office, they're like, okay, cool, it's time to trade. They open up TradingView, they look at the markets, they're like, okay, cool, this is bullshit, I don't want to trade it. But then what do? Well, they've got nothing else to do with the rest of their day. They've got nothing else to do for the next 3 hours in New York session. So they sit there and they continue to watch price. They sit there and they continue to look at candles. And the longer you sit there and look at price, the longer you sit there and try to process information, you get that analysis paralysis that sets in. And eventually, and I can promise you, any trader, if you look at a chart for long enough, you're going to end up placing a trade. There's no other way about it. The only reason you look at price is to ultimately do what? Well, it's to place a position. So if you sit there for long enough and you look at price and you look at a chart, you're going to end up trading. It's as simple as that. But simply by having something else to do, let's say you come in, same scenario, but this trader also has like a side business. They come into the markets, they look at price, they see this current nasty depletion and this unsure sentiment, etc. And they're like, you know what? This is not a nice price. I don't want to trade it. Let me go work on my other business. Let me do some editing work. Let me go do some more outreach. Let me go do whatever it is that you're doing for that business, and it shifts your attention. Now, I'm not just saying drop trading and do something else. I'm just saying slowly shift your attention during the down periods. And again, this is the beauty of trading. It doesn't have to be a bad thing that you're not trading. It just means that you have more time to do something else. And that is the whole reason we're even trading, though, is for the freedom to do other things. So utilize your time, be efficient with it, and have that other period to grind and do something else. And then during the good months, when price is having the huge breakouts like this, I promise you it will make up for it. These months right here will make up your entire year. Because again, this is a trading opportunity. This is a trading opportunity. This is an opportunity. So on and so forth. And you have just opportunity after opportunity. These are the market phases right here where the evaluations get passed. These are the market phases right here where you make those big 5-figure payouts. These are the market phases right here where everything changes for you and your trading. If you're patient enough to get to these opportunities, if you're patient enough to wait for the market to give you these sort of breakouts, and only if you're skilled enough to actually capitalize off these movements. See what I'm saying? So it's a very fine line in it. Really avoiding the correctives and really waiting patiently for the impulsive to really capitalize off of that movement. Now, if we come right here to the dollar, I want to show you guys another little trick that I use to try and identify whether or not the market is high probability or low probability. And it's simply looking at the dollar. Very, very similar process. And again, it all comes back to session one. I really recommend go back, rewatch session one, impulsive and corrective waves. It's the foundation of everything. But when you look at the dollar, what does the dollar do? Well, essentially, the dollar controls the market, especially when it comes to the indices, US 30, NASDAQ, German 30. They're very largely dependent on the dollar's price action. Now, a little easy trick that you can do is, again, when you come to the dollar and you see these periods right here of price action, you see these accumulations, you see that the dollar has no clear structure. The dollar has no clear sentiment. The dollar doesn't know what it wants to do. Again, that's an indication to you that there is no clear structure. There is no clear bias. There's no clear real strength in the market, and it's probably going to reflect on the indices. Very, very obvious. Same time, when you have the large impulsive breakouts like we did right here, and granted this was a little bit fundamental related, but when there's a lot of dollar strength or a lot of dollar weakness, it gives you a clear structure, it gives you a clear sentiment, and it's probably going to reflect on the indices. Now, this is not always the case. It's not always like a one-to-one ratio. Sometimes you're going to come onto the dollar and it's going to be completely moving sideways. And then you look at US 30 and it's ripping to the upside. And you look at NASDAQ and it's ripping and it's super clean price, etc. I would always default to what the indices are doing because that is the price action you're primarily trading. However, there is a very strong correlation between what the dollar is doing and what the indices are doing. I would say it's like a 70-30 split. 70% chance that if the dollar is messed up, probably the indices are messed up. 30%, they'll just do their own thing and it doesn't really matter. But it's another little trick that you can use. But again, if you come onto the dollar's moving sideways. You come onto the indices are moving sideways. What do? Don't trade. Simple as that. Shut your laptop. Go do something else. Go mash some push-ups. It doesn't matter. Just don't fucking trade. I don't know how many times I can say this. And I don't know how clear this video was and how valuable it was. But if you guys are going to take away one thing from this video, one thing from this episode, it is to trade less. That is it. I can promise you what made me a profitable trader is not the strategy. It's not the system. It's not like some crazy psychology book I read. What actually made me profitable is learning that I didn't have to take that many trades. What really made me profitable is going from taking 20, 30 trades a month, essentially one trade a day, to looking at taking max 2 trades a week, essentially. That is actually what made me profitable. And not only taking 2 trades a week just because I feel like taking 2 trades a week, but waiting for the higher probability setups, waiting for the markets to give me the breakouts, waiting for the dollar to give me the strength or the weakness, waiting for the indices to give me that clear higher time frame structure, and then looking for my trading opportunities. Simply, all I've done was avoid the bullshit. All I've done was avoid the consolidations. All I've done was just avoid taking unnecessary losses because I could see that it was not high probability. That is it. And that's where I'm going to leave the video today. Hopefully, you guys enjoyed. We'll be back for episode 12, day 12 of the bootcamp very, very shortly. See